We do get Wells Fargo today. So here's the WF Wells Fargo. And this one doesn't have a big earnings number posted, but the revenue is massively negative, minus 17%. Interest income minus 18. And so, yeah, they Wells Fargo is already getting hit really hard right now because they don't have investment income. They're not rotating into other sectors. They only have the banking interest income, which is suffering from low interest rates, and then the defaults are a huge threat, and they have already cut dividends from 51 cents to 10 cents. So, uh, yeah, here there's a bit more on this one. So yeah, Wells does not have a strong secondary business that compromise a decent chunk of revenue to see it through. Similar to JP Morgan and Citigroup, what we've seen they have income from investment sectors and market trading and commodity trading, things like that. And the economic turbulence ahead is now threatening the company's ability to return cash to the shareholders, which we're seeing here in the dividend cuts. That's a huge dividend cut. Um, this is the big one that I was kind of looking for. Wells Fargo, I expected to be pretty bad, and it is bad. I guess actually they're actually coming in worse than some estimates. Yeah, this is really bad. They're coming in even worse than the estimates by a little bit, whereas the other companies, usually the estimates are on the bad side, and they, you know, overestimate how bad it is going to be, I guess, because most of the earnings that we've seen have come in better than the whatever the little estimates from whoever the estimates are from that they're quoting in whichever article you read. But generally, things are coming in better than expectation. Wells Fargo is actually coming in worse than expectation, and they're already cutting dividends. And so management says we are extremely disappointed in both our second quarter results and our intent to reduce our dividend. Our view of length and severity of the economic downturn has deteriorated considerably from the assumptions used last quarter, which drove the 8.4 billion addition to our credit loss revenue in the second quarter. It's critical in these uncertain times that our common stock dividend reflects the current earnings capacity, assuming a continued difficult operating environment, evolving regulatory guidance, and protests our capital position if economic conditions were to further deteriorate. So given this, we believe it's prudent to be extremely cautious until we see a clear path to broad economic. I don't know if that was supposed to end there, but yeah, the actual economic outlook is pretty bad for the financials, especially if they don't have other sectors. So, because a lot of the banks have investment banking and different things like that, or like a big credit card sector. Some of the banks, like Citigroup, uh, has all the credit cards and things like that. But Wells Fargo, I mean, their revenue is from loan interest. They're a pretty basic banking kind of business model, and so yeah, I didn't expect them to come in worse than expectations. I expected Wells Fargo to be a pretty ugly one, but I actually didn't expect it to be this ugly. And then here we say the stock, even after entering earnings trading at just over half its book value per share, an incredibly low valuation, fell almost 6% to 23.90 a share. So that leaves a dividend yield of 4% and indicates investors possibly see earning estimates worsening. And it also presents a buying opportunity to long-term investors. So let's go take a look at that. Yeah, so here's WFC stock, Wells Fargo and Company. And so you can see, I mean, relative to the other financials, I'll take a look at the general financial sector, but Wells Fargo has a weaker chart than most of the banks, and this makes sense because they don't have the income that several other banks have that is helping them still produce, still produce some earnings right now. Yeah, so I guess Wells Fargo is really the sort of like a poster child bank for the conditions that are really bad for banks right now. They're gonna be hit probably the most uh, due to the low interest rates that could be going lower. We'll take a look and see if there's any movement on those. Uh, and then the dollar is still holding strong, which is not going to be, we're not getting inflationary signals. Basically, you want interest rates to trade up, you want the dollar to break down to get an inflationary environment that could be helpful for the banks. Because the banks generally make money on that interest rate spread. And, as we've seen in Europe over the last 10 years, when you have zero or negative interest rates, it just crushes the banking sector. They don't make money on their loans. Their balance sheet goes like neutral or upside down, and they just can't make money. It's just all risk, and they don't make money. And so Wells Fargo is not quite in that position yet. Um, but what we're seeing now is that they're just not making much money, and now all these defaults that are going to come in are just going to be disastrous because they really don't have anything to offset it. And so, all right. So that said, maybe this is a good time for a long-term investor to jump into Wells Fargo because it is sort of. Let's take a long-term look at this thing. Let's get out to like weekly candlesticks and see where Wells Fargo has been. All right. So here's the long-term chart on Wells Fargo. I mean, you can see kind of the takeoff, and then leading up to the financial crisis, like banking was great. They had good interest rates. They could make money. They just loan out, and people got a little crazy loaning out, too risky because loans were just so profitable. It was easy to do that. But then the financial crisis here put Wells Fargo down to where, like $8 or $9. Yeah, so I mean, they crashed really hard during the financial crisis. And so the American banks had high enough interest rates since the financial crisis to operate well, whereas like the banks in Europe were getting crushed over this time period. Um, But now, now we're seeing the American interest rates going down to a level where it's not profitable. And so, is this a good buying opportunity? It really depends. Mostly, mostly on the bond rates is what I would think. And so, yeah, this is a low area near where it was in the financial crisis. So, well, I mean, if it goes up from here, then it's low. If it goes down from here, it's not. So, so I guess let's take a look at the bonds real quick and see what's going on. Like this is the 5-year to 30-year bond spread here, and it's been trending up a little bit, flattening the yield curve out. But if we take a look at the individual bonds, let's take a look at like a 2-year. Yeah, this is the 5-year here. You can see the 5-year is kind of trending down. It looks like it might break down a little. It's not like breaking down like making a big move, but if these bond yields trade down hard, um, that's a deflationary kind of environment, which would be trying to force like the Fed funds rate down to negative numbers, which would be disastrous for the bank, especially a bank like Wells Fargo that doesn't have the other income sources. And then as we get out to longer bonds, the 10-year is doing the same thing, just kind of flattening out and maybe making a move down, but it hasn't yet. And 30 years, same kind of thing. Yeah, the 30 years started to move up, and we saw this. We saw the yield curve spread starting to widen here as the 30-year spread, as the 30-year yield went up here. And it was for about 3 days. It's like, oh, we may be moving into like an inflationary kind of signal because the yield curve got steepened, but it didn't even last a week until it traded back down, and then it's been flattening out even more since then. And so the yield curve spread flattening out just says like we don't know what's going to happen basically. And if it drops negative and like then steepens in negative territory, that would be really bad. But like this case, what it looks like it was about to do is just the long end started going up where it was looking more like an inflationary signal. But basically what you want for what the banks want is they want a steeper yield curve and they want higher interest rates. And right now it looks like the interest rates, even on the long end, are trading down and down. And so it hasn't quite broken down yet, but right now it doesn't look like it's trending in the right direction. And so I don't see like a long-term bet on the banks being a good idea at the moment. And this is interesting. The dollar is continuing to trade down. So I mean the dollar against the DXY is the dollar against mostly against the euro. But the dollar has been on an increasingly strong trend line here since the financial crisis. So it got really weak into the financial crisis, and then people took out huge amount of dollar loans, expecting the dollar to get weaker from there. People thought the dollar was going to continue to get weak after the financial crisis, and then the dollar has been getting stronger the whole time since then, which has been making those loans more and more difficult. And now I'm hearing all this talk about how the dollar's breaking down and whatever. I mean, here you can see it's not really breaking down. I mean, it got down around 70 in the financial crisis. It's been on a strong uptrend ever since, and it's at support now. So this is a pretty critical area to see what the dollar is going to do here. And it does look like it wants to make a move down, but we'll see if it actually does that or not. Um, it could just wobble around support here for weeks and weeks or whatever. And I'm not really expecting it to break down. I know a lot of people think that it is breaking down and it's a big deal, but to me, I'm just seeing it sitting on this trend line and it's just sitting there. So it doesn't look like any kind of a big deal to me yet. I mean, it needs to get under here pretty good, back test this thing. Like it needs to establish that it's under here and make it move down. So that's not that far away. Like 93, 92 range would be really breaking the trend line here. And that could set up a move down to who knows, somewhere in the 80s. But yeah, that's an important thing to watch. And so the dollar breaking down could be an inflationary signal that could be helpful for the bank. So those are a couple of things to watch, like with Wells Fargo in mind, if it's a long-term good investment. As of right now, it doesn't look like it. It doesn't look like it's not. It just doesn't. We're not getting the signals yet to make a good guess at whether we're moving into an inflationary or a deflationary kind of scenario here. And then when I say deflationary, I'm not talking about like the price of a hamburger. I mean that like the dollar is going to be stronger than other currencies, and those other currencies will in turn be stronger than their own commodities. So basically, deflationary in the sense that worldwide commodity prices would be going down. That's what I mean when I say deflationary. And that environment is bad for bad for the banks and would also probably be bad for the stock market, unless the government comes out with crazy helicopter money to fight that deflationary scenario. And they are completely prepared to do that. If you look at the Treasury General account, they have $1.6 trillion of helicopter money queued up, ready to fire into the economy. And I think that's exactly when they would do it. If we get these bond rates trading down where it's putting negative pressure on the Fed and the Fed funds rate, then I think that's when we'll see the Treasury General account actually get released. They'll release the hounds, but yeah, as for now, I think really the Fed and the Treasury are kind of, I've been calling it ping pong. They're like kind of going back and forth because the Fed can just make bank reserves. They can't create inflationary money like as we've seen in the Japan crash. The Bank of Japan was purchasing all kinds of stuff. They're doing like monstrous amounts of QE and money printing, and they had a 20 or 30-year deflationary scenario. Like their whole market crashed, and then they had a 20-year bear market afterwards. That was just a super extended deflationary bear market. And that was with tons of money printing, tons of bank intervention. And so the US Treasury this time, it is possibly trending into that same scenario that Japan was in, but this time the government has MMT and helicopter money at the ready, which could, could fight off the deflationary environment, but may push into a high inflation or hyperinflationary environment on the other side. So that's really the things to kind of look out for. And yeah, if you listen to a lot of macro theory, I think almost everybody expects high inflation to happen at some point, but a lot of people expect a deflationary scenario first. And I think that has a high probability, and neither one has happened yet, basically. And so that's what we're still kind of waiting on, these signals. And so if we go into the deflationary kind of environment, a stock like Wells Fargo does not look super appealing. And that should be downward pressure on the financials and the market in general. Um, you know, and then the Treasury could come out and blast tons of helicopter money and flip that thing completely in the other direction in a matter of weeks or something. So it's gonna be it's gonna be a really interesting couple of years here. But for the banks, I think the interest rates is a big deal as far as their profit margins on loans and everything go. But I think the real story is going to be how intense are all of the loan defaults going to be? Like, how big is the solvency crisis, the loan defaults, the bankruptcies? How far is that going to go? Because all of those companies have massive amounts of loans out, and when those loans don't get paid, it's devastating to these banks. And you see the banks they're creating these big funds, preparing to handle all these defaults. I mean, they just basically have huge chunks of cash. I mean, we saw JP Morgan had it was over $34 billion, trending towards $35 billion of liquid money that they're prepared to just lose as defaults come in. That's money that they have an account just to lose on defaults. And all of the banks in Europe even have bigger accounts than the U.S. banks right now, which is interesting to see. But we've seen the government kind of staving off, people's mortgage payments and rent payments and loan payments and car payments, all kinds of payments. Like, it's like you can defer this, you can furlough that, and blah blah blah. But after, I mean, how long can that go on? Like, one more month, 3 more months, and then when it comes due, then what do? You negotiate, because it's all owed. As soon as that period passes, then people have to pay, and they can't. So then you start the whole process of negotiating the loans and defaulting and declaring bankruptcy and everything. And so basically we've seen companies that were doing poorly prior to this crisis have started going bankrupt already. I mean, like these old clothing retail stores that have older styles, and the brick and mortar store model that can't compete with the online shops, like they were doing poorly already. And now that online shopping has been accelerated and you can't go to the stores, I mean, they've been forced. Something that could have taken 10 years to happen now is happening in 1 year, and those companies are going bankrupt. Like, that's one thing. Businesses that were failing anyway, failing a little faster is one thing, um, but companies that people expect to do well, I guess, like the zombie companies that we have that people think are doing well. There's tons of tech companies that everybody loves that have no earning, like no revenue, and they're just losing money like every year and just taking out more and more loans. Like, are they going to get bailed out? Are they going to continue to just not make any money long term? Are they going to get bailed out for 10 years or something and just operate at a loss? I mean, I don't know. I don't really know what's going to happen. And, the Fed comes out and says they're going to buy some bonds and stuff like that. Like, that'll slow it down, but that's not going to stop all these companies that, are going bankrupt. Like, they're going to have to basically nationalize the companies to keep them afloat if they don't want them to go bankrupt. So, uh, so far, the government and the Fed have tried to avoid doing bailouts, and they have just started buying bonds to increase the liquidity. So they're just kind of pushing it off a little bit. And now we're getting into the period where it's starting to happen anyway. And we just have to see how far they're going to go. I mean, the Fed could start buying everything up, just really buying everything, which would be like a central bank version of nationalizing things, I suppose. But yeah, we'll have to see kind of how the trend shapes up. It's really hard to predict what they're going to do. I don't even think they know what they're going to do yet. And as far as the inflation deflation scenario, it's just kind of in between. Let's hop over to the S&P and see what's going on. So I mean, basically a deflationary scenario would be bad for the markets. It should be. But if they're gonna just print and buy everything up, then it's gonna get really really tricky to predict what's going on. So yeah, I have this super wide zone. I mean, this goes all the way back to January 2018. This is Volmageddon, where we had the first high volatility move, and so we've been in a high volatility kind of environment this whole time. And this bounce was impressive. So if you look at the bubble model that I had set up, I have this 12-year support line. I have the 2-year support line here. And so, well, on the weekly candles, you can't really tell, but if you get out on to like hourly candles, yeah, here, if you come into hourly candles, you can see the crash here where we broke the 2-year trend line, double back tested it, broke down under this one, did a little double back test as well. And so if you watch my other videos, I had a model set up on this crash to look like the sort of the deflationary scenario similar to Japan, and the Fed and the Treasury were able to come out and produce more than enough liquidity to push through, and we're back up. We're back up at this 2-year trend line here, where we broke down a long time ago. In February, March, we broke down through here. But we swung all the way back up, and this is where we rejected off of when we got the first move down. So the Fed basically stopped all the QE back here at the beginning of June. It was, I think it was a couple days prior to this peak here, where they basically turned off the spigots. But when it was up here, flat in the flat, we realized like, well, the Fed balance sheet has flattened out, and we're like, I don't know if it's going to trade, if the balance sheet's going to start coming back down or what they're going to do. But basically, this whole period, the whole past month, the Fed has not been pumping money. The balance sheet has actually come down this whole time, and the stock market has just been trending sideways. And so this trending sideways with very limited liquidity here, which is pretty interesting. And there's tons of liquidity that already came in, so I don't know how long it takes to kind of balance that all out, or when they're planning on printing more. But you get to see the balance sheets Thursday after markets. Sometime usually the balance sheets come out a couple of hours after the markets close on Thursdays. But yeah, so right now, I mean, I had the idea that when they stopped expanding the balance sheet, that we could see some downside sooner than this, and we've just traded sideways. So I mean, the current market conditions basically are saying that whatever, like, the amount of liquidity that we have now is is fine at these levels until we get another maybe liquidity squeeze or something like that. It looks like it could just trend sideways for a while, and I doubt the Fed's going to print while it's doing that. I mean, they have no reason to come out and print a bunch more until there's a reason to do so. And they basically have recapitalized the banks, and they stepped into the swap line. They did swap lines. They did international repo market. They were directly providing liquidity to anywhere that wasn't functioning, and then so the balance sheet went absolutely nuts. But now they're reeling back the swap lines. People weren't even using them that much. They're bringing the money back out of the repo markets. They're not buying much. I saw the mortgage-backed security buying went down to almost nothing. They're still buying some treasuries. They're buying a few bonds here and there, but I mean their bond purchase limit is 750 billion. They bought less than 10 billion of that so far. So I mean, relative to the 3 or 4 trillion or whatever they printed up, like 10 billion is no big deal. So I mean that's kind of the liquidity situation. We haven't really broken into an inflation or deflation environment. There's not a lot of liquidity supporting the market now. It's just kind of chopping around in this area, which is interesting. And yeah, and what are we trading on today? So I wanted to see if this resistance has held, and we're pushing up above it again. So, and we didn't get a bearish setup. It looked like we might get a bearish setup here, but it's pushing above. It's pushing above the resistance area, and it didn't break down. It did a really weak bounce off of this kind of lower area here. It really needs to break down through here in order to move down in the bearish direction. So it looks to me like this market is just going to flop around a little bit more, in this general area. There's tons of resistance areas overhead, holding back bullish breakout kind of movements. Like the bullish movements should be more choppy and fighting kind of up and chopping and going sideways and stuff like that over the next whatever time period, a couple weeks or something on the bullish side. I don't expect it to be crazy bullish, although this was a pretty good swing up here. But if it does break down below here, I think a bearish move could be a little bit bigger because there's just really no resistance until you get down here to the moving averages and the long-term support lines. So yeah, so that's kind of what I'm looking at on the general market. Like the market conditions don't seem good, but the market seems okay with it. The earnings reports are coming in bad, and Wells Fargo came in even worse than expected. But we're getting these financial sectors reports coming in bad, and this is what you get. Like the financial ETF is just kind of chilling. It's not doing much. So yeah, so I mean that's pretty much what I'm seeing now is like we're on the edge of some trends that could take off in one direction or another, but it just hasn't really broken. It hasn't broken into inflation or deflation, and dollar is getting weak, but it hasn't broken through the super long-term trend support. And the Qs are an interesting one, like the infotech sector, these financial, or not, I'm sorry, not financial, the infotech industrials here are, had a pullback, which is not weird to get a pullback for a day or maybe two, um, but this for the market to actually do a downtrend, these really need to actually make a move down, and then the rest of the market could move down with them in order to see probably like any kind of a actual downtrend for longer than a couple of days. The Qs probably need to lead it, and then you see the weaker sectors like the Russell just kind of chilling. The financials, even with all the financial earnings coming in, are just kind of staying there, which is pretty interesting. I think I think the VIX is one that is, this is one thing to watch, really, is that the VIX is actually on a pretty aggressive uptrend right now. And this is at the same time that the general market is, I mean, we just saw it is relatively flat, even a little bit up, and the VIX is going up against that. So I think that is really the only signal that I see that would indicate a down move, maybe happening pretty soon. Is just this kind of volatility fear index is increasing, and the stock market's just kind of sitting there as fear increases, and that's what we got here. We got the VIX moving up against the flat market here, and that was the island top before we got that down move, but it didn't follow through. It was just a short down move. So it's possible we get another one of those. It's possible we get another pop in the VIX and another short down move, but I don't expect it to be a long down move unless the Nasdaq and the Qs lead it down, and then we might see a longer down move. So yeah, I guess that's just kind of the look for today. The financials are in a really bad spot, and the economy is in a really bad spot. But as far as the market, it's just kind of chilling on limited liquidity and not moving too much. So until we start to see some stuff break in one direction or the other, it's pretty hard to predict a direction other than sideways, which is, I guess, the thing to do is just say it looks like it's still going sideways. So that's what's up. Not investment advice. And please subscribe and drop a comment, and I'll say hi. So happy trading. And yeah, as far as Wells Fargo long term or anything, like you really need to know what type of environment we're in, and we don't yet. So I don't know. I don't know, not yet, but we might get some interesting movements here in the next week. And yeah, cheers.